Joining me to discuss all of the drama surrounding Groupon and the daily deal market, we have A.B. Mendez of GreenCrest Capital out in New York, who's been bullish on Groupon's growth prospects in the past. And here in studio is Rocky Agrawal, blogger and consultant to various institutional investors, who had this to say on Twitter. If Facebook moves out of your market, that is not a victory. It may just mean the smartest people in the world think it's a not so great market. Rocky, welcome back to Bloomberg West. You know, first of all, is it really because this is a bad business, or are Facebook and Yelp pulling back here because Groupon and LivingSocial have the market cornered?
I think it's fundamentally a bad business. I wrote a couple months ago, I wrote a post talking about how I wanted the entire space to die, and I wanted Google to get out of it because they were too good a company to do this. And we're seeing that with Facebook. Facebook is getting out because they think they're too good of a company to be in such an exploitative business.
Now, A.B. in New York, you're generally more optimistic about Groupon. What do you think about the confluence of all these things in a row, though? Facebook, Yelp pulling out, Groupon traffic dropping 50% over the summer.
Well, I think what you're seeing is sort of what's to be expected, sort of a shakeout in an industry that Groupon popularized just a year and a half ago. And because there was very little intellectual property or patents to defend that business, hundreds, if not thousands of competitors came in. Groupon has pretty well demonstrated that its earliest cohorts of subscribers and customers are profitable, so they're investing aggressively to grab additional profitable cohorts until it's no longer profitable to add more customers, at which point they'll scale back the marketing spend. But I think Facebook just has better places to allocate its capital. It ran a test. The test was moderately successful, but they have other places where they can generate more cash flow, so it makes sense.
That said, we have an analyst from Forrester Research saying that the daily deals business over the next few years is going to die. Do you think that that's not true?
I do believe that is not true, absolutely. I think you'll continue to see Google investing. It makes sense in order for this business to make sense for anyone other than Groupon and LivingSocial, which have a very large first mover advantage in this space. Any other player has to be very niche focused or has to have some other bargaining chip, some other piece of its business that makes it effective in this space. For example, Google already has Google Maps, which has a massive latent potential for local and hyper-local marketing. They will leverage that in their own deals offering. Foursquare, that's become a platform play, has the mobile location-aware functionality that lets them source their own deals directly and bring third parties, including Groupon and LivingSocial, onto their location-aware or hyper-local deals platform. So it didn't make sense for a lot of these smaller guys, a lot of Me Too's that were just trying to bolt on a daily deals business. But for the core players now, Groupon, LivingSocial, and Google left standing, it makes a lot of sense.
And at least according to Experian Hitwise, traffic on LivingSocial is up 27% over the summer. Rocky, let's turn to you. I mean, the business in some places is still growing. Does that make you a bit more optimistic or positive about the outlook here?
The sequential growth has gone down tremendously between first quarter and second quarter. And the other thing that Groupon has shown pretty convincingly is that they have a hard time getting people to buy. 80% of the people on their mailing list have never bought anything from Groupon. And of those who have bought something, only less than half have bought again from Groupon. So most people who have bought a Groupon have never bought another Groupon, which is pretty frightening. They're claiming that their marketing costs won't increase, but they can't get existing customers to buy again.
You've been kind of valiantly covering this whole Groupon story since they filed for the IPO. In your post today, you were a bit more positive about Google offers. Why do you hate Groupon so much in particular?
Well, the thing I have trouble with Groupon is that they're creating a lot of risk for a lot of people who don't really understand it. If in the .com days, Pets.com blew up and you lost $200, that wasn't the worst thing in the world. If Groupon goes bad as a business, you could lose your entire business, and that I have a problem with.
A.B., what about the motivation for merchants here? Rocky wrote earlier today that Groupon and LivingSocial aren't necessarily motivated to get customers to return to merchant stores after they do a single deal. They're just moving on to the next deal, and that's, in the end, not good for merchants.
Well, I would respectfully completely disagree. The reason Groupon and LivingSocial makes so much sense for local merchants, especially in a current strained macro environment, is that it's the best way to drive hundreds, if not in some cases thousands, of new customers through your front door with zero upfront marketing spend. And that's why this business model has caught on like wildfire. It's not going to make sense for everybody. It makes a lot of sense for certain kinds of businesses. And I would turn what Rocky said upside down and say, well, if 83% of those subscribers have not yet bought, that's massive upside potential for converting those into paying customers as the targeting gets better and better, as it has so far, and we expect to see it do over time.
A.B., how do you expect all of this controversy to impact Groupon's IPO? Are we going to see a negative impact here when Groupon does finally list?
Well, first off, let me just make this caveat. I am perceived as a big cheerleader of Groupon. I love the business, Groupon and LivingSocial. Don't ask me how I like it above a $20 billion valuation. At my firm, GreenCrest Capital, we focus heavily on advising our clients on separating hype from reality and what valuation makes sense. But I think looking forward towards the IPO, management at Groupon needs to exercise a lot more care and discretion in how they address both the street and how they address their employees internally with facts and information that may get out to the street. So I do believe they get to market successfully by the end of this year, but not if they fail to take their feet out of their proverbial mouths from now through the IPO.
Rocky, how much should Groupon be valued at?
I would probably value it at $1 to $2 billion right now. I think it's very close to collapse. And if all the information that were perfectly assimilated today, it would be shut down tomorrow by the credit card companies.
Strong words from Rocky Agrawal. Groupon should be valued at $1 to $2 billion. All right, thanks so much, Rocky, here in studio, and A.B. Mendez of GreenCrest out there in New York. Really appreciate your thoughts today on Groupon.